Hey everyone, welcome back to Corporate Decoder, the place where we make sense of the complex world of finance. And today we're diving into American Express's latest report, which sounds like it's all about loan performance, but let's see if there are any hidden surprises in those numbers. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed to the channel. If you like digging deeper into these filings with a community of like-minded folks, join our Discord server linked in the description below. Alright, so what we have here is an 8K filing from American Express. Now, an 8K is basically like a press release for publicly traded companies, but for really important events that happen between their regular financial reports. This particular one is dated July 15, 2025, and it's focusing on something called Regulation F disclosure, which is all about making sure important information is shared with everyone at the same time. Think of it as preventing unfair advantages. This part just tells us what rules they're following to make this fine. It's standard stuff for companies reporting to the Securities and Exchange Commission, or the SEC. Here they list the securities they have registered. The big one for most people is their common shares, traded under the symbol AXP on the New York Stock Exchange. That's the stock most of us would recognize. They also mention specific notes they've issued, like those 3.4333% fixed to floating rate notes due in 2032, which are probably more for investors focused on bonds. Now we get to the good stuff. This section is where they're giving us some data on how their loans are performing. They're calling it delinquency and write-off statistics. This is the core of the report. They're giving us a snapshot of how many of their US consumer and US small business loans are either late on payments or have been written off completely. They're covering 3 months, April, May, and June of 2025, and then looking at the 3-month period ending in June. Let's focus on the US consumer loans first. At the end of June 2025, the total amount of loans they had out there was about $92.6 billion. This went up slightly from May, where it was $92 billion, and also from April at $90.7 billion, so the consumer loan book is growing a bit. Now, the crucial part, delinquencies. For consumer loans, 1.3% were 30 days past due in June. This is actually down slightly from 1.4% in April and holding steady from May. Now, 1.3% might sound small, but when you're talking about over $90 billion, that's still a significant amount of money that's not being paid back on time. It means about 1 in every 100 consumer accounts is a bit late. This is where loans are considered so unlikely to be repaid that the company basically gives up on them. For US consumers, this rate was 2.1% for the 3 months ending in June. This is up a tiny bit from 2.0% in April and holding steady from May. A 2.1% write-off rate means out of every $100 in loans, about $2 are being lost. On $92 billion, that's roughly $1.9 billion being written off. That stings. Moving on to the US small business loans, here the total amount outstanding was $30.1 billion at the end of June. This is actually down from May, where it was $31.6 billion. So their small business loan portfolio is shrinking a bit. For small businesses, 1.6% were 30 days past due in June. This is up slightly from 1.5% in May and back to where it was in April. So small businesses seem to be a little bit slower to pay back their loans compared to consumers. A 1.6% delinquency rate on $30 billion means more than 1 in every 60 small business accounts is late. And for small business write-offs, the rate was 2.6% for the 3 months ending June. This is up from 2.4% in both April and May. So not only are small businesses a bit more likely to be late, they're also more likely to default completely. A 2.6% write-off rate on $30 billion means about $780 million could be lost. Adding it all up, the total loans held for investment for both consumer and small business were $120.7 billion in June. This is down from $124 billion in May, but up from $120.3 billion in April. So the overall portfolio size is relatively stable. Now they make a point of saying this data is different from what they report for their lending trust. This trust is a separate entity they use to package and sell off some of these loans. They're saying the loans in that trust might have different characteristics than their main portfolios, so the performance could look different. They then give us some data for that lending trust itself. This is important because it shows a different slice of their business. For the trust, the ending principal balance was $25.3 billion in June. This is pretty stable across the months. Here's an interesting one. The annualized default rate net of recoveries for the trust was 1.3% in June. This is the same as in May and April. This rate for the trust is actually lower than the general write-off rate they reported for their consumer business earlier. This could be because the loans they package into the trust are of higher quality, or because the way they calculate it is different as they mentioned. The total amount that was 30 days or more delinquent in the trust was $0.2 billion, or $200 million. This is also stable across the months. The trust seems to be performing quite well with lower delinquency and default rates compared to the overall portfolio. And finally, the signature. This is just the formal part of the filing confirming that someone authorized by the company, in this case James J. Killerlane III, the corporate secretary, has signed off on it. And the date of the signature is July 15, 2025. Let's look at the big picture here. American Express overall seems to be navigating the current economic climate reasonably well. Their consumer loan portfolio is growing, and while delinquencies are up slightly from their lowest point, they're still at very manageable levels. The write-off rate is a bit higher, especially for small businesses, and that's something to keep an eye on. Small businesses are often more vulnerable to economic downturns, so seeing that 2.6% write-off rate is a warning sign. However, the fact that their core consumer business and their securitized trust portfolio are showing stable or at Mike's 6% write-off rate is a warning sign. However, the fact that their core consumer business and their securitized trust portfolio are showing stable or slightly improving credit metrics is a positive sign for Amex's business as a whole. They seem to be doing a good job of balancing growth with risk management, though the small business as a whole, they seem to be doing a good job of balancing growth with risk management, though the small business sector does warrant closer observation. Now, looking at these results more broadly, American Express appears to be a resilient company. Their ability to maintain relatively low delinquency and write-off rates, even with economic pressures, speaks to strong underwriting and customer management. The consistent performance of their securitized trust is especially noteworthy, perhaps indicating a strategy to offload the riskier loans. A notable risk is indeed the performance of their small business segment, which could be an early indicator of broader economic weakness. The opportunity lies in their continued ability to attract and retain high-quality customers across both consumer and small business segments, leveraging their brand and rewards programs. In conclusion, American Express delivered a report showing healthy, albeit slightly mixed, credit performance for the middle of 2025. The consumer side looks solid, while the small business side shows some strain. The overall direction is steady, but they'll need to watch that small business segment very carefully. Alright, that's our breakdown of American Express's latest filing. What's your take on these numbers and what they signal for the company's future? Do you think the small business segment's performance is a cause for concern? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate filings. Don't forget to check out our Discord community in the description for more discussions. Thanks for watching. See you next time.